This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors. I'd like to thank you for taking the time to look at our look ahead for Q4 2025. Please read all of the disclosures very carefully. We look at this next quarter and beyond as a two-speed economy. We're at a pivot point where wage growth continues to buoy households, especially in healthcare, but job creation has stalled and even slipped negative. That tension captures the essence of a two-speed economy, a resilient consumption on one side, labor market drag on the other. It's my opinion that holiday spending will be the true arbitrator for Q4 GDP, and so far the balance still tilts towards a reasonably healthy, if uneven, picture. Inflation's sticking around, but mostly because of housing costs. Strip that out, and the cooling trend is clear. Layer in the fact that because we're a heavily service-oriented economy, the Trump tariffs have had very little impact to date. Therefore, the Fed's poised for two more cuts this quarter, pulling the Fed funds rate towards 3 3/4. This sets the stage for monetary policy to turn from restrictive to supportive, an inflection point that could sustain growth even with tariffs in the background. So, what's next for fixed income? The bond market staring down a refinancing wall that's unprecedented with government debt maturities in the next couple of years. That makes lower rates a structural necessity, not just a cyclical decision. Historically, rate cuts produce strong returns, and especially in the first 8 months of that rate cycle. The challenge now is less about if bonds will deliver and more about how much is already priced in the current bond market. Earnings momentum is certainly going to meet a reality check. Corporate earnings are still powering ahead, with double-digit EPS growth forecast for 2025 and 2026. Valuations are stretched, yes, but buybacks and profit margins are going to provide that ballast we need. We're at that juncture where fundamentals are strong enough to justify optimism, but stretched enough to warrant vigilance. Again, we're at that tipping point. Equity investing still favors the patient. It's tempting to think that this bull market's long in the tooth at 3 years, but history and the last innovation cycle suggests we may only be in the middle innings. Pair that with rate cuts and the forward return profile for equities, and it all looks surprisingly attractive. Patience still may be one of the best trades as we work through short term corrections on the long trend in this upward cycle. Developed markets are quietly offering solid earnings growth, with valuations about 7% below the US. That's a relative value story worth noting, but not yet compelling enough to force an overweight. At this pivot point, staying underweight seems prudent, especially when you consider muted developed markets GDP growth. We'll still keep an eye on it, but we still remain that underweight. Emerging markets present the most intriguing setup. Earnings growth on par with US and developed markets, but valuations nearly 18% cheaper. Add in Asia's consumer rebound, and a selective overweight looks justified. One point of caution: China's property market is a real drag on consumption. And that's worth noting as it is the second largest economy in the world. While their wages are growing, their consumption and animal spirits are being suppressed. We'll watch this trend in Q4. Looking at our mean reversion dashboard, across styles, regions, and sectors, valuation gaps are flashing. Growth still commands a hefty premium, while areas like energy remain deeply discounted. That dispersion tells us markets are at a valuation crossroads. Some sectors will mean revert down, others may set up for a catch up. Either way, opportunity comes from acknowledging the spread, not ignoring it. Our views and recommendations in summary. To me, the allocation pivots are clear. Maintain weightings to U.S. large cap growth and small caps, extend bond duration into the rate cut cycle, and keep EM exposure despite volatility. We'll also hedge with some defensive large cap value for 2026. The bigger backdrop is regime change, deglobalization, higher neutral rates, energy transition, and AI productivity shifts. At this point, portfolios need to reflect not just today's cycle, but the structural drivers shaping tomorrow. Thank you for taking the time to review with us our Q4 2025 look ahead. And if you have any comments or questions, you can reach me at the link below, or please reach out to your advisor.